What's up, guys? Coach B here. Wanted to get into another video of these beginner option strategies. This playlist is meant to be a follow-up to the Options Basics playlist. I recommend that you go watch that first if you haven't already. Anyways, today we're going to be discussing covered calls. So we've talked a lot about buying call option contracts and how those work, but now we're going to be looking at this from the opposite spectrum as the call seller, or the appropriate term is the call writer. So first thing, writing a covered call means you're selling a call contract to someone else. And as we've discussed before, we know that a call contract represents 100 shares. So in order to do this, you need to own 100 shares of the stock. Okay. Second thing, you have to understand here, by selling the contract, you're giving someone else the rights to buy away your shares at the strike price. I always like to enter into any trade, thinking that whatever I don't want to happen can happen. And so if I'm writing this call, I need to know there's a high possibility that my shares might get bought away from me. So whatever that strike price is, I need to be comfortable with selling my shares at some point. Third, and this is the fun part, when you sell any contract, you immediately get the premium. So remember, it's the opposite of buying a call now. So when we buy a call contract, we're paying the seller a premium. And when we sell a contract, we collect that premium now. So you get that, whatever that premium is, goes into your trading account. You get to use it to go buy your own calls or, buy shares, whatever you want to do with it. Okay. So let me give you an example of how this might work. Let's say you own 100 shares. You bought this stock a couple months back for $8. And when you bought it, you kind of had an anticipated price target for the end of the year of maybe like $12. Well, like I said, a couple months went by, stock's trading at $10 now, and you still want to own the stock. You don't want to sell and take profits because you still think it has long-term potential. But you also feel like the stock may trade sideways for a while. Maybe it had too much growth too fast. Maybe it might dip down a little. So your outlook on the stock in the short term is somewhat bearish, but again, you don't want to sell. So covered calls is a perfect opportunity to make a little cash. So you go look at the options chain about 45 days out. That's typically where I like to sell my contracts at. And, I like to collect about 5 to 10% premium off the stock price. This fluctuates too, depending on the IV. For example, if a stock has, ridiculously high IV, I might try to grab like 20 or 30% premium. Low IV, I might try to grab maybe like 2 to 5%. But for this example, I'll kind of settle for 5%. Okay. So stock's worth $10 right now. That means it's worth about $1,000. And, I'd like to target a premium that's going to give me a 5% return off that stock value. So that'd be roughly about $50, 50-cent contract, $50. So roughly 45 days from now, let's just say that the $14 strike, okay, is going for 50 cents. And I sell the covered call for 50 cents at the $14 strike. Now, immediately, I'm going to get that $50 in my account, which is a 5% return on my shares that I'm holding. So I just made 5%. Now, even if the stock was to decline by 5% in the next 45 days, I'm still covered. I've already collected that. So it kind of protects my downside a little bit, at least up to 5%. But before we look at the option chain, let's talk about the 3 ways this can play out. So again, we owned this stock. It's worth $10 right now. We went in and sold the $14 strike for 45 days from now and got $50. Okay. So there's 3 ways this could play out. First way, the stock goes down. It was trading at 10 when I sold the contract. It starts dipping down closer to like 975, 950. Looks like it might be heading for $9. The good news is this contract's going to expire worthless. Okay. And you don't need to worry about your shares being taken away. You still keep the shares and you get to keep that $50 in premium because that was yours right off the bat when you sold the contract. The bad news is you need to hold the stock as long as you hold the contract. So you have a couple options. If you really like the stock, just hold it. Consider the losses offset by the premium, and it is what it is. You know that your stock will bounce back later. If you don't really like the stock anymore and you want to just get out altogether, you can always close out the contract. Okay, you already received $50 in premium, because at the time the contract was selling for 50 cents. But now, it's getting closer to expiration. Stock price drop. That $14 strike might be selling on the chain for like 10 cents. Okay, so you can go in right now and buy to close that contract for $10 because that's what it's selling for. That leaves you with a $40 profit, right? You got $50 up front and you went in and bought the contract back for $10. You got a $40 difference on the premium. And then now you have the ability, you're free and clear of any sort of liability on the shares. So you could decide whether or not you want to keep your shares, sell some of them, do whatever you want with it. Okay, that was scenario one. Now, scenario two, let's say the stock stays around 10, maybe even rises all the way up to 13. This is the best case scenario because the contract still never hit that $14 strike price. So you get to pocket that premium that you already got, the $50, and you get to keep your shares. They never get called away from you. And along with all the unrealized profit you made when those shares rose up to $13, right? Like now all of a sudden, 45 days passed, you got $50 in your pocket. You also have these shares that were worth $1,000 45 days ago, and now they're worth $1,300. So you really made out in that scenario. That's kind of the best case type of look at it. Now, scenario three, this is the other side that you need to be okay with. Let's say the stock rises more than you expected. Maybe it goes up to $16. And at expiration, your contract, is going to get exercised and you're only going to receive $14 per share. So you're going to get $1,400, which is still great. I mean, the stock was sitting at $1,000 in value, and now you're getting $1,400. That's a 40% gain, and you get the $50 premium that you already got. So really, you walked away with $1,450. It might suck that you missed out on the bigger run in the stock because it's trading at 16 right now, but that's part of the risk you assume when you sell the contract. Again, you should always assume this will be the case. Be comfortable with the strike price that you sell the contract at. If you wouldn't have sold the stock for $14 when it ran up there and got to 14, don't rush to go grab that $50 premium because you're risking your long-term position in the shares. And that's probably the biggest risk. I say risk, you're still walking away with profit, but you're going to miss out on the longer run. Okay, so you just got to be comfortable with it. Now let's take a look at the option chain real quick. Okay, we're going to start with the Ford. Ticker symbol is F. It's a low IV stock. I mean, the IV is sitting right here at 44%. But let's look at what we could expect to collect on a lower IV stock. So with Ford, we'll come out to November, which puts us at about 58 days out, but that's pretty close to 45. Open up this option chain here, and right now this stock's trading at $13, let's say, so it's worth about $1,300 in value. Low IV. So if I wanted to make 5%, I'd likely target something for about 65 cents, but I don't even have those options here. I see the $14 strike. I can get $52, but that's only $1 increase off this current trade price. I'd probably look to this $15 strike at $27. Let's say I bought this stock for $9. It's up at 13 right now. I'd be comfortable with letting go of my stock at $15, collecting $27 premium, which is kind of closer to 2%, which is what I said, for low IV. That's not a bad return, 2% on in 45 days. And this is more of a blue chip type stock that doesn't move much. Not to mention, if I do get called away and I sell this $15 strike, I'm looking at a $200 gain from the current trade price, which is a little more than 10% from where we're trading at right now. So, that would be kind of where I would target this for a low IV. Look to maybe make 2%, 45 days out. This is actually 58. But let's look at a stock with a little bit higher IV. So here we're going to pull up VIH. Right now, this stock's IV is at 76%. Okay. It's trading right around $10. Okay. I tried to find something that was relatively the same in price. And, 45 days out takes us again to about this November chain, which is actually 58. And that 5% target, okay, so at $10, this stock is worth in total value about $1,000. If I wanted to get 5% return, I'd look for something about $50, Well, looking here, I can kind of go here at this $45 mark. Is pretty close to 5%. It's a $14 strike. That's actually a 40% increase. So if this stock was to move past $14, in the next 45 or 58 days, I'm making 40% anyways. It's worth $1,000 now. I'm going to sell it for $1,400. That's a 40% gain plus the $45 I'm going to get today when I sell this call contract. Okay, so that's kind of the way I look at it, and that's close to that 5% range. That's usually where you want to be at with like an average priced IV stock. Now I'm going to show you something a little bit crazier. This is ATER. This is a stock that's been ripping for a while now. If we go down and look at the IV, it's actually at 228%. These are the premiums that, if you're lucky, even something above 100%, that you'd want to sell covered calls on a stock, again, that you don't want to dump, but you want to keep long term. Make some money off this high IV. Okay, so same thing. We're going to go 58 days out. Stock's worth about, let's just say $1,400 right now, because it's trading, or $1,445, whatever. It's trading for $1,445 right now, assuming I own 100 shares. So with the IV the way it is now, I might want to look to collect like 20% in premiums. So that would be maybe around this $20 strike here. I can get almost $3. So that's, let's just say $300 I'm collecting right now, which protects my downside if this stock drops down closer to $11, because I want to hold it long term. But at the same time, I'm able to put a 30% gain in my pocket. And if it does go up and surpass $20 in the next, what are we looking at? 58 days, I'm going to get bought out for $2,000. So I'm getting $2,000 now, or I'm getting 300 now, $2,000 if it does get exercised. And that's a huge gain. If you put that together, that's almost 100% gains from where we're at right now. Stocks trading at $14. I'm going to walk away with almost $2,300 if this gets fully exercised. And if it doesn't, I got to put $300 in my pocket and made about 20 to 30% off my current share price. So, this is where this strategy really plays out the best, is on high IV stocks. And that's really what you want to be looking for. But you could use this in any scenario. You just kind of have to gauge where you want to sell that strike price out and where your comfortability is. Now, there's three things I want you to remember, take notes on this thing. Is one, I typically go 30 to 45 days out when I'm selling covered calls. More time, so if you give 60 days or, 3 months or whatever you do, equals a higher premium, but it also gives you more risk that the stock can run and you lose your shares. Okay, so we were looking at examples around 58 days. If you were, trying to sell this stock for a year out or 6 months out, you could have collected some ridiculously high premiums, but at the same time, now there's a greater risk that you're going to lose your shares. Okay, and now you're stuck in this trade for quite some time because you need to keep those 100 shares to back it up. Okay, which brings me to my second one. You can always close the contract early by buying to close. Okay, you sold to open a new position. You can close it by buying the same exact call you sold, same month, same expiration, same strike price will get you out. And that in itself is its own strategy, right? So if I sell today, that strike price on ATER, and I was able to collect $3 in premium, $300, and now all of a sudden the IV starts dropping and the price might stay the same, but the IV starts declining tremendously, and I could get my liability out of that by just buying that contract back for $100. I just collected $200. I got $300 today, bought it back for $100 later as the IV dropped a couple weeks from now or something, and I'm out. No more liability. Still have my 100 shares. Walk away with a little free premium. Third thing I want to say is, I typically want to wait for IV to increase on my stock before selling covered calls. Okay, when IV is high, the premium you collect, like the example I just showed, is going to be much higher and give you an opportunity to close out early. You might sell a call and collect that $200 in premium, and a week or two pass and that contract's going for $25. buy it back. That leaves you with 175 in profit off the premium. No more risk. Now you're free to do the same exact thing again and sell new covered calls when the IV spikes up, or do whatever you want with your shares. Anyways, that's it for today. I know this was a longer one, but I wanted to touch on all the bases. If you guys have any questions, leave them down below in the comments. Ideas for future videos, please leave below. Again, I'm going to continue with these option strategies. You can also check me out streaming every day in the pre-market. Been trying to find some runners to day trade and also talking about some of the stocks that I'm into. Really just hanging out and having fun. Good luck in the markets. Hope to see you soon.